You know, I've spent my entire life watching price move across charts, and I'm going to tell you something that changed everything for me. Most people think price moves because of news. They think it's earnings reports, economic data, political events. And sure, those things matter, but they're not what really moves price. Not at all. What I discovered after decades of watching the smartest money operators on Wall Street, after sitting in rooms with men who moved millions of dollars with a single phone call, after losing my own money and making it back and losing it again, until I finally understood what I discovered is this: price doesn't move because of news. Price moves because someone with a lot of money wants it to move. And that's not a conspiracy theory. That's not some dark secret. It's just how markets work. It's the most natural thing in the world once you see it. But most people never see it. They spend their whole lives reacting to price movement, chasing it, running from it, getting whipped around like a leaf in a storm, and they never stop to ask the simple question, who's on the other side of my trade? Who wanted me to buy right here, right now? Who needed me to sell? Because I promise you, when you're feeling that overwhelming urge to buy, someone very smart, someone with far more money and far more patience than you, they wanted you to feel that urge. They needed you to feel it. That's how they get out of their position. That's how they distribute their shares to you at the top. And when you're terrified, when you're selling in a panic, when it feels like the world is ending and you just need to get out, you just need the pain to stop, that's when they're buying. Not because they're cruel, not because they enjoy your suffering, but because that's the only time they can accumulate a large position without driving the price up against themselves. This is what I call the composite operator. It's not one person. It's not some shadowy figure in a dark room. It's the combined effect of all the smart money, the big money, the institutional money working in concert, sometimes by design, often just by shared interest. They all need the same things. They need to accumulate without pushing price up. They need to distribute without collapsing price too soon. And they need you, the public, the retail trader, the small investor. They need you to do the opposite of what they're doing. That's not cynical. That's just reality. And once you understand this reality, once you really see it, everything changes. You stop being the victim. You stop being the fuel that feeds someone else's fortune. You start reading the footprints they leave behind because they can't hide. Not completely. The big money leaves tracks. They have to. When you're moving millions or billions of dollars, you create waves in the market. You create patterns, volume patterns, price patterns, patterns of behavior that repeat over and over because the mechanics of accumulation and distribution never change. Human nature never changes. Fear and greed never change, and that's what I'm going to show you today. I remember when I first started on Wall Street, I was young, ambitious, hungry to make my fortune. I watched the ticker tape like it held the secrets of the universe. And I noticed something peculiar. The same patterns kept appearing week after week, month after month. A stock would creep up slowly, methodically, like someone was quietly accumulating shares without wanting anyone to notice. Then suddenly, everyone would be talking about it. The newspapers would run stories. Your neighbor would mention it at dinner, and the price would shoot up like a rocket. That's when I'd see something even more interesting. The smart money, the insiders, the professionals, the ones who'd been buying quietly for months, they weren't buying anymore. They were selling. Not all at once, mind you. That would be too obvious, but selling nonetheless, distributing their shares to an eager public who believed the story, who thought they were getting in on the ground floor. By the time the public was fully convinced, fully committed, the smart money was gone and the stock, it would collapse under its own weight. I witnessed this cycle so many times that I began to document it. I drew charts, made notes, identified the subtle signals that separated one phase from another. I realized that price movements weren't random at all. They were orchestrated, controlled, predictable if you knew what to look for. The market, I discovered, moves in 4 distinct phases. Think of them as seasons in a year. First comes accumulation, the winter. This is when smart money is quietly buying. When everyone else is still fearful from the last crash, When pessimism is thick in the air, prices move sideways, boring, uneventful. Most people aren't paying attention. That's precisely the point. Then comes markup. The spring and summer prices begin to rise, slowly at first, then faster. The public starts to notice. The stories get better. Everyone wants in. This is where fortunes are made by those who bought during accumulation. Next is distribution. The late summer, early fall. The smart money starts selling to the public, but it's disguised. Prices still look strong. There's excitement everywhere. The news is overwhelmingly positive. But underneath, the foundation is crumbling. Finally comes markdown. The winter returns. Prices collapse. Panic sets in. Everyone who bought during distribution is trapped, losing money, desperate to get out. And then the cycle begins again. This is why understanding market structure isn't just about making money. It's about survival. Because here's what most traders never realize. You are always in one of these phases. Right now, today, the stock you're watching, the position you're holding, the trade you're considering, it exists somewhere on this continuum between accumulation and distribution. The question is, do you know where? I've watched fortunes evaporate because someone thought they were early to accumulation when they were actually late to distribution. I've seen careers end because a trader mistook a reaccumulation for a top. The market doesn't care about your ignorance. It doesn't offer second chances or participation trophies. It simply takes. But when you understand this structure, truly understand it, everything changes. You stop being reactive. You stop chasing. You stop hoping and praying and wishing the market will do what you want. Instead, you become a reader of human behavior compressed into price and volume. You see the composite operator's footprints in the sand. You recognize when smart money is building positions while everyone else is scared. You spot when they're quietly exiting while everyone else is euphoric. Let me show you what I mean. Think about a stock that's been in a long downtrend. Brutal. Month after month of lower lows. The news is terrible. Earnings disappoint. Analysts downgrade. Everyone who owned it feels like a fool. Then something subtle happens. The stock stops going down. Not dramatically. It doesn't shoot higher. It just stops. It drifts sideways in a range. Maybe it bounces weakly, then falls back, bounces again, falls back again. Most traders ignore this. It's dead money, they say. I'll come back when it shows strength. But what are they missing? Volume. During those declines within the range, volume is diminishing. The selling is exhausted. And on those weak bounces, volume sometimes expands slightly. Someone is absorbing every share that frightened holders want to dump. This is the spring being loaded. This is accumulation in real time. The composite operator is patient. They know panic creates opportunity. They know that the best prices come when everyone else has given up, while the crowd scrambles in confusion, selling at losses. The composite operator quietly accumulates. They build their position methodically, piece by piece, like an archaeologist brushing sand from a buried treasure. No rush, no panic, just patient accumulation at wholesale prices. This is what professionals call spring, the final shakeout before the markup begins. Picture a spring being compressed. The more pressure you apply, the more potential energy you store. When you finally release it, that stored energy explodes upward. The spring phase is that moment of maximum compression. One last brutal sell-off, one final wave of capitulation that convinces the last stubborn holders to throw in the towel. And here's the beautiful irony. The very thing that terrifies amateur traders is exactly what the composite operator needs. That final panic creates the liquidity they require to complete their accumulation without driving prices higher prematurely. I've watched this pattern repeat itself hundreds of times across every market imaginable. The details change, but the psychology never does. Fear is predictable. Greed is predictable. And those who understand these forces can position themselves accordingly. Let me give you another example. The silver market in 1980 after the Hunt Brothers Corner attempt failed. Silver crashed from its highs. The public was terrified. Silver is dead, they proclaimed. The industrial demand is gone forever. But while newspapers published doom-laden headlines, certain operators were quietly accumulating massive positions. They understood something the public didn't. The price had fallen below the cost of production. Miners were shutting down operations. Supply was contracting while industrial applications continued to expand. The panic created the opportunity. The accumulation happened in silence. And when silver eventually rallied, those patient operators made fortunes, while the crowd stood on the sidelines, still traumatized by their earlier losses. You see, the composite operator doesn't just understand markets. They understand human nature. They know that people feel pain from losses approximately twice as intensely as they feel pleasure from equivalent gains. This psychological asymmetry creates predictable behavior patterns. When prices fall, the average trader holds on too long, hoping to break even. When prices finally reach their breaking point, they sell in disgust, usually right at the bottom. The composite operator understands this pattern intimately because he creates it. He accumulates their shares at the bottom after shaking them out, then marks prices up while they watch from the sidelines. By the time the public's confidence returns and they're ready to buy again, he's ready to distribute at the top. This is why I say the tape tells a story, but only if you learn to read it without emotional interference. Let me show you how this plays out in real distribution. The professional has been accumulating for months at lower levels. His inventory is now substantial, but he can't simply dump millions of shares into the market. There wouldn't be enough buyers, and prices would collapse before he could exit. So, he creates the illusion of continued strength. Prices are marked up on decreasing volume, just enough to maintain the appearance of a healthy advance. The public sees new highs and interprets this as confirmation of a continuing bull market. What they don't see is the absorption occurring on every rally. Watch the behavior on up days versus down days. During distribution, rallies become labored. They require more effort, more buying power to move prices higher. Yet on down days, prices fall easily on relatively light volume. This tells you supply is overwhelming demand. But the professional is controlling the release of that supply to avoid panic. The newspapers help his cause tremendously. They print bullish stories explaining why the new highs are justified. Analysts issue strong buy recommendations. Brokerage houses send out optimistic reports to their clients. All of this generates the buying power he needs to complete his distribution. Meanwhile, the professional is watching specific technical signals that the public ignores. He's counting the waves of buying enthusiasm and measuring them against actual volume. He's noting how each rally penetrates a bit less than the previous one. He's observing the increasing volatility, wider daily ranges that signal emotional, unstable trading. Then comes the spring, the final trap. Prices make one last push to new highs, breaking out above previous resistance. The public sees this breakout and rushes in, convinced they're catching the next leg up. But this is precisely where the professional unloads his final inventory. The amateur looks at that breakout and sees confirmation. The professional sees distribution completion. While the crowd is buying what they think is strength, the composite operator is selling into that buying pressure carefully, methodically, without disturbing the price structure enough to reveal his true intentions. This is the art of the exit. The professional never announces his departure. He doesn't crash the market with panic selling. Instead, he creates the illusion of continued strength precisely when he's achieving maximum liquidity for his exit. Every rally becomes an opportunity to transfer ownership from strong hands to weak hands. And here's what you must understand about this final stage. The very enthusiasm that marks the top is what makes it possible. Without that final surge of public buying, without that last wave of optimism and momentum chasing, the professional couldn't complete his distribution. He needs you to want what he's selling. He needs you to believe the story so completely that you'll take his inventory off his hands at premium prices. The volume during this phase tells you everything if you know how to read it. High volume on rallies, declining volume on reactions. The opposite of what you saw during accumulation. Why? Because the professional is the primary seller now, and he sells into strength when maximum buying power is present to absorb his supply without collapsing prices. Watch the quality of the rallies, too. They become labored, exhausting. Each new high requires more effort, more news, more justification. The ease of the uptrend is gone. Prices hesitate more frequently. Where once momentum carried prices smoothly higher, Now, every advance meets resistance. That resistance isn't coming from nowhere. It's coming from professional selling. The public interprets this differently. Of course, they see consolidation. They see healthy pullbacks. They see the market catching its breath before the next leg higher. They create bullish narratives to explain what are actually bearish symptoms. And this is exactly what allows distribution to continue undetected until it's too late. I've watched this pattern repeat itself across every major market cycle in stocks, in commodities, in every speculative instrument man has devised. The details change, the names change, the specific catalysts and narratives change, but the underlying structure of distribution remains constant because it's based on unchanging principles of human psychology and market mechanics. The professional understands that the public will always prefer hopeful interpretations over harsh realities. This cognitive bias is exploitable, and the composite operator exploits it systematically during distribution. That's why every rally during distribution must be carefully analyzed, not just celebrated. When you see the market surge upward after a period of weakness, your first question shouldn't be, how high will this go? It should be, who's providing the supply that's absorbing this demand? Because here's what most traders miss. Every genuine rally requires genuine buying power. It requires capital flowing in with conviction, not just scalpers looking for quick profits. During accumulation, that buying power comes from the composite operator quietly absorbing everything offered. But during distribution, the operator has reversed roles. Now they're the ones providing the supply. So when you see a rally that fails to reach new highs or barely touches the previous peak before falling back, you're witnessing the operators selling pressure overwhelming whatever buying enthusiasm exists. The public sees hope. The professional sees supply dominating demand. Let me illustrate this with something I observed repeatedly during my years analyzing market movements. Picture a stock that's been trading between $40 and $45.5 for several weeks. There's been good news, optimistic analysts, favorable business conditions, all the elements that keep public interest alive. Then one day, it breaks upward, reaching 47 on increased volume. The amateur sees this breakout and thinks, finally, here comes the real move. They buy at 46, 47, thinking they're catching the beginning of a major advance. But watch what happens next. The stock trades at these elevated levels for a day, maybe two. Volume remains high, which the public interprets as confirmation of strong demand. But then, almost imperceptibly, the tone changes. The stock stops advancing. It hangs around 47 for a session, then drifts back to 46 by the close. The next day, it opens steady, but can't rally. Within a week, it's back to 43, and the hopeful breakout has been completely retraced. This is what I call the false breakout, and it's one of the cruelest lessons the market teaches. The move looked real. The volume was there. The newspapers might have even printed something optimistic, but underneath the smart money wasn't buying. They were distributing into strength, using your enthusiasm as their exit liquidity. Here's the hard truth. The market doesn't reward hope, it rewards patience and discipline. When you chase a dubious breakout without confirming that absorption has occurred, you're gambling, not trading. You're betting that this time will be different, that the resistance that held for months will suddenly crumble because you want it to. But the chart doesn't care what you want, so what separates a legitimate breakout from a false one? How do you avoid being trapped on the wrong side of a move that everyone swore was the real deal? The answer lies in what happens after the initial thrust. A true breakout doesn't just pierce resistance, it holds above it. The stock doesn't immediately retreat back into the range. Instead, it consolidates at the new level, building a platform of support where resistance used to be. Volume remains healthy, but not frantic. The tape shows buyers stepping in on any minor dip, defending the breakout zone as if their lives depend on it, because in a sense they do. The operators who accumulated at lower levels and pushed the stock through resistance have a vested interest in keeping it elevated. They want higher prices, not a collapse back into the old range. So they support it, they absorb any selling that emerges, they create the conditions for the next leg higher. In contrast, a false breakout shows weakness almost immediately. The stock might spike above resistance intraday, but it closes back below it, or it holds above for a day or two, then collapses on heavy volume. The operators dumping their shares into the hands of the last hopeful buyers. There's no follow-through, no institutional support, just a crowd of retail traders left holding the bag, watching their stop losses get triggered one by one. And this is where most traders give up. They blame the market. They blame manipulation. They blame bad luck. But the market isn't the problem. The problem is they never learn to read what's actually happening beneath the surface. See, the professionals don't announce their intentions. They don't ring a bell at the top or the bottom. They operate in silence, accumulating when everyone's terrified, distributing when everyone's euphoric. Your job isn't to predict what should happen. Your job is to observe what is happening and position yourself accordingly. Let me show you what I mean with a real scenario that plays out constantly in the market. You're watching a stock that's been grinding higher for weeks. Steady, methodical gains, volume increasing on the up days, decreasing on the pullbacks. The composite operator is in control, quietly accumulating a large position. Then suddenly the character changes. The stock makes a dramatic upward move on huge volume. The headlines start flowing. Analysts upgrade their targets. Retail investors pile in, convinced they've discovered the next big winner. But here's what you need to see after that climactic move. The stock starts behaving differently. The rallies become weaker. The pullbacks become more severe. Volume spikes on down days and dries up on attempted recoveries. The professional trader recognizes this immediately. Distribution? The composite operator is using the increased liquidity and enthusiasm to unload their position to the eager crowd. The amateur sees something entirely different. They see a healthy correction and a strong uptrend. They see a buying opportunity. They add to their position, averaging down, convinced the stock will resume its march higher. And that's exactly what the professional wants them to think. Because here's the truth most traders never grasp. The market is designed to transfer wealth from the reactive to the observant, from those who trade their emotions to those who trade the evidence in front of them. Every single day, the same patterns repeat. Absorption zones at support where professionals accumulate. Distribution zones at resistance where they systematically exit. Tests and springs that shake out weak holders before major moves. I developed the concept of the composite operator, the imagined entity that represents all smart money moving as one coordinated force. When you view the market through this lens, everything simplifies. You're no longer watching thousands of random transactions. You're watching one intelligent operator executing a campaign. The composite operator accumulates when the crowd is fearful. He marks up prices when supply has been absorbed. He distributes when the public finally becomes convinced the trend will continue forever. He marks down prices when the crowd is fully loaded with inventory they bought at inflated values. This isn't conspiracy, it's simple economics. Those with capital and patience will always extract value from those driven by emotion and urgency. Let me show you how this plays out in modern markets. Take Bitcoin. In late 2017, the composite operator had accumulated between $3,000 and $5,000 throughout 2016 and early 2017. Methodical buying during a period when most still viewed cryptocurrency as a fringe experiment. The markup phase was systematic, higher highs, higher lows, increasing public interest. By November 2017, the conditions for distribution were perfect. Massive public interest, media saturation, your neighbors asking how to buy Bitcoin, classic topping action, wide price spreads, climactic volume, but no further upside progress. The composite operator distributed throughout this euphoria. He sold his $3,000 inventory at $15,000, $18,000, $19,000. The crowd, convinced they discovered the future of money, bought enthusiastically. The markdown was brutal from $20,000 to $3,000 in 14 months. Those who bought the dream at the top watched 90% evaporate. The composite operator, he was accumulating again in the fear, preparing for the next campaign. This pattern repeats endlessly because human nature doesn't change. The technology differs, the asset classes evolve, but the underlying psychology remains identical to what I observed decades ago. The beauty of the Simons method is its universality. I developed it analyzing industrial stocks in the 1980s, but it applies perfectly to cryptocurrencies, forex, commodities, any liquid market where buyers meet sellers. Let me tell you about a fascinating parallel I witnessed in my early days. In 2000, there was a spectacular rise and fall of a company like Pets. Calm during the dot-com bubble. The patterns on the tape were identical to what you see in modern markets. The composite operator accumulated shares quietly while the public lost interest. Then came the markup phase, beautiful, methodical, with spring tests and backup actions that looked textbook perfect. Finally, distribution at the top, masked by exciting news about internet revolution contracts. The stock collapsed from highs to pennies in months. Fortunes evaporated. But those who understood the method, they sold into strength during distribution and profited handsomely on the decline. Now, you might say, Jim, that was a different era. We have instant information now. Social media, algorithmic trading, and you'd be right about the superficial differences, but the core dynamics haven't changed one bit. The composite operator today might be a hedge fund with sophisticated algorithms instead of a pool operator with a telephone. The mechanism of accumulation and distribution remains identical. I want you to understand something crucial. The Simons method isn't about predicting the future. It's about reading the present with extraordinary clarity. When you analyze volume and price together, you're reading the actual transactions, the real battle between supply and demand. You're not guessing or hoping. You're observing evidence. Think of yourself as a detective at a crime scene. The charts are your evidence. Volume shows you the intensity of the struggle. Price shows you who's winning. The ranges tell you whether the smart money is building a position or exiting one. Springs and up thrusts reveal the final tests before major moves. This forensic approach to markets is what separates professional speculation from gambling. The gambler hopes for favorable outcomes. The professional speculator waits for favorable conditions, then acts decisively. And here's what I find most elegant about this method. It compounds over time. Each successful campaign builds your capital, but more importantly, it builds your judgment. You develop what I call tape sense, an intuitive feel for when markets are ready to move and when they're simply churning. This intuition isn't mystical. It's pattern recognition developed through systematic observation and experience. This tape sense becomes your greatest asset as you navigate increasingly complex market situations. You'll notice market behavior that escapes less experienced traders, the subtle weakening of rallies, the diminishing enthusiasm on breakouts, the quiet accumulation that precedes major moves. These nuances don't announce themselves with fanfare. They whisper and only trained ears can hear them. As your campaigns accumulate, you'll face what I call the intermediate trader crossroads. You've moved beyond beginner mistakes. You understand the basic principles. You've had successes, but now you must decide, will you remain a small-scale operator, or will you think like the professionals who move markets? This decision isn't primarily about capital, though that matters. It's about perspective. Small traders think in terms of tips, patterns, and quick profits. Professional operators think in terms of campaigns that might unfold over weeks or months. They think about accumulation zones, distribution patterns, and the manipulation necessary to execute large positions without moving markets against themselves. Study the professionals. Watch how substantial positions are built not in a single aggressive day, but through patient, methodical accumulation during periods when the general public loses interest. Notice how distribution occurs near market tops when enthusiasm is highest and the public is most eager to buy. The professional is doing the opposite of the crowd at critical junctures, but doing it so skillfully that the crowd doesn't notice. This is why I've emphasized throughout this journey that you must think for yourself. The crowd will always be wrong at important turning points because they're driven by emotion rather than analysis. They buy stories rather than studying supply and demand. They want certainty in a realm that offers only probabilities. Your edge comes from accepting uncertainty, while the crowd seeks false certainty. Your edge comes from patience. While the crowd chases action, your edge comes from systematic observation. While the crowd reacts to headlines, the crowd wants prediction. You accept probability. This single shift in mindset changes everything about how you approach markets. I've watched traders destroy themselves not through bad analysis, but through the psychological torture of needing to be right. They enter a position and immediately their ego becomes attached to the outcome. Every tick against them becomes a personal attack. Every moment of uncertainty becomes unbearable. You cannot trade this way and survive. The professional accepts from the beginning that any single trade might fail. They structure their risk accordingly. They observe the developing pattern with detachment, ready to exit if the evidence changes. They don't marry positions. They don't defend losing trades. They simply follow the tape. This is why I never give predictions about where markets will go. I teach you to read what they're doing right now. The moment you shift from what might happen to what is happening, you gain tremendous power. Look at how the crowd operates. They read an analyst's prediction. They convince themselves it must be true. They position themselves based on this prediction. Then they spend days or weeks in agony as the market does something entirely different, unable to exit because that would mean admitting they were wrong. The Simon's trader operates differently. You observe accumulation developing. You note volume characteristics that suggest smart money positioning. You wait for the spring that tests and finds support. You enter when the evidence aligns. And if that evidence changes, if volume dries up, if support fails, if distribution characteristics appear, you exit without emotion. No predictions, just observation, no certainty, just probability managed through position sizing. No ego, just evidence. This approach removes 90% of the psychological torture that destroys traders. You're not trying to prove yourself right. You're not fighting the market. You're simply following the footprints of the composite operator, ready to change course the moment those footprints suggest a different direction. The crowd will call this wishy-washy. They'll say you lack conviction. Let them. While they suffer through drawdown after drawdown, defending positions that the evidence no longer supports, you'll be adapting, surviving, and ultimately thriving.